The Peter Schiff Show.
Today's podcast is sponsored by NetSuite, the easy-to-use cloud-based business management software for every aspect of your business. Download the CFO's Guide to AI and Machine Learning at netsuite.com/gold. The guide is free to you at netsuite.com/gold. netsuite.com/gold.
Well, today we had the conclusion of the two-day FOMC meeting where the Fed announced probably the most highly anticipated rate cut in history. Because remember, there was no doubt that the Fed was going to cut rates at this meeting. So the only thing the markets were trying to figure out was by how much the Fed was going to cut. Was it going to be 25 basis points or was it going to be 50 basis points? Now, anybody who is a regular listener of my podcast knows that I have been in the 50 basis point camp for a long time. In fact, when the Fed didn't cut rates at all in July, I said that the next thing they're going to do is cut by 50. In fact, I thought they wouldn't even wait for a meeting. There was a chance they would have cut right away, and they would have had the stock markets continue to sell off the way they did the week prior to that statement and immediately following the Fed's lack of a rate cut. And so I've been saying 50 basis points for a long time, but it wasn't until probably last week that the markets got to where I was, where the probability of 50 was actually slightly greater than the probability of 25, but it was 100% probability they were going to do something. And so the Fed delivered on what I have been expecting. In fact, once I saw that the markets were anticipating 50 basis points, it was pretty much a done deal that the Fed would deliver on that expectation because the Fed never wants to disappoint the markets. In fact, had the Fed cut rates by 25 basis points, the markets would have tanked because it would have been a big disappointment. So I think in order to avoid disappointing the markets, Powell cut rates by 50 basis points. But when I said I was in the camp of 50, I wasn't advocating for 50. I was just stating what I thought the Fed was going to do. I wasn't advocating for any cuts. In fact, I think the proper thing to do is to raise rates. In fact, rates should already be much higher. They never should have stopped hiking interest rates when they did. And they shouldn't be cutting them now, but they are. But they're not cutting them because they've succeeded in reducing inflation. I mean, that's what Powell wants you to believe. In fact, during the press conference, Powell used the fact that the Fed waited so long to cut rates and was so patient as proof that, you see, we know inflation is going down because we waited so long. And now the fact that we can cut 50 basis points, the fact that we have that confidence is proof that inflation is going to go back down. After all, we waited so long, right? And I said on my podcast that that was exactly what they were going to do. They were going to wait simply so they can say that the long wait is proof that inflation is going back down, even though it's not. Inflation is not going back down. I think the Fed probably knows this, but it doesn't matter. They have to pretend that it's going down because they need to justify the rate cuts. And, ironically, too, there's a lot of talk about price controls now because Kamala Harris, proposed price controls on groceries. And, of course, all the Republicans jump on her for advocating price controls. And, I pointed out the irony of that because the minimum wage is a price control, yet a lot of Republicans don't want to repeal the minimum wage. And, in fact, Donald Trump today, I was just listening before this podcast to Trump's rally in Long Island, where he not only promised to restore the SALT deductions that he took away, right? The SALT deductions got capped at $10,000 as part of the, job cuts and tax deal that Trump passed, right? That was one of the offsets for the revenue loss. But now, not only does Trump want to extend the tax cuts that are due to expire next year, but he wants to eliminate the cap on SALT deductions that he initially put in there, which means that the hole that he would blow in the huge deficit would be even bigger, right? But of course, he's talking to a New York audience, and so he wants to advocate for tax cuts to New Yorkers, and so that's what he's doing. I mean, he's not talking about the fact that he's the guy that got rid of it, but now he's promising to eliminate, or restore what he got rid of. But the real thing I wanted to point out that Trump said towards the end of his speech, he promised a cap on credit card interest rates at 10%. Well, that's price controls. He wants to control the price that credit card companies can charge for interest, which of course is price controls. And it's not going to work. It's going to blow up. It's going to result in millions and millions of people losing their credit cards. Why are credit card interest rates so high? Because credit card interest rates are over 20%, right? The Fed funds rate, even before the 50 basis point cut, was 5.25%, right? So there's very little relationship between 21 or whatever they were and 5.25%. The reason credit card rates are so high is because the loans are very risky, right? They're unsecured loans, and a lot of credit card borrowers don't pay. They default. And so what happens is the people who do pay have to pay enough in interest to cover the losses from the people who don't pay, right? And it's a competitive market. Think about all the banks that are issuing credit cards, right? And so if rates could be lower, they would be lower. Now, one of the reasons, too, is there's all kinds of rules and regulations that drive up the cost of lending. And so all of that is incorporated into those credit card rates. And maybe if, Trump, if they promise to repeal some of these regulations, maybe credit card rates could come down that way. But if you just promise a cap, what's that going to do? That's going to destroy the credit card industry, or most of it. And credit card companies are going to have to cancel millions of credit cards because otherwise they'd lose too much money. And they're not in business to lose money. They're in business to make money. And if they need 21% to make money, well, then that's the rate. And if they could make money at 10% in a competitive market, that would be where the rates would be. But they're not there for a reason. Now, I don't believe for 1 second that if Trump wins, he's going to keep that promise. But it's a promise that he made. And the irony should be obvious, because you can't criticize your opponent for advocating price controls and then advocate price controls of your own. But the ultimate price control is the Fed controlling the price of money, interest rates. So all these Republicans who are condemning, and rightfully so, Kamala Harris's plan to put price controls, support the Fed. In fact, almost everybody, including all these Republicans, supported the Fed lowering interest rates today, right? Again, that is the government fixing the price of interest. In capitalism, in a free market, that price would be set by the market, but it's not being set by the market. And like any price control, the level that government central planners pick is wrong, right? The free market discovers the correct price. But bureaucrats who just select a price, right, always get the wrong price. And usually because they're politically motivated to either set the price too low or too high, right? With the minimum wage, it's high price and you get unemployment. But here now for interest rates, the powers that be, the pressure is to have a low rate. And that's what we have. Because if you just took an objective look at the American economy and looked at the record low savings rate, right? All-time record low personal savings rate. You looked at the record high debt that we have, not just record government debt, where we're 34.3 trillion in debt, but record household debt, record credit card debt. Everybody is loaded up with debt, and there's very little savings. What does that tell you about interest rates? That they're too low, right? Because low interest rates both encourage borrowing, because borrowing is cheaper, and they discourage savings because you don't earn a high return on your savings. Now, absent the government's intervention, interest rates would have to be much higher to restore some type of balance where the higher rates would encourage people to save because they would earn more interest on their savings, and it would reduce borrowing because borrowing would be more expensive. And so there'd be less borrowing, including the government. The government would have to find ways to cut back on its spending because the cost of financing the borrowing would be too high. So we know objectively that interest rates in this country are too low right now. Yet despite that, the Fed just cut interest rates by 0.5%. And when Powell announced this, and he read his prepared statement to the reporters who had assembled to ask him these, bogus questions, he mentioned that rates have been restrictive for some time, that they've had this restrictive monetary policy, and that the purpose of this 50 basis point rate cut was just a recalibration of policy to get closer to a neutral stance, that they didn't want to be tight anymore. They wanted to be neutral, but they were never tight. They've always been easy. And the proof of how easy the Fed has been is the amount of debt that we have, right? We wouldn't have all this debt and such a shallow savings pool if we had high interest rates, if the Fed was tight. Also, if the Fed was tight, the Dow Jones wouldn't be at an all-time record high, which is where it is. And of course, the S&P, which is a little bit off the high than NASDAQ, but they made record highs this year. They have huge gains. That is a sign that rates were low, right? If the Fed really got restrictive, we would have had a big bear market. No question about that. And if the Fed really was restrictive, we wouldn't have, this record low savings rate. People would be saving more and taking advantage of those high yields. And we wouldn't have all this borrowing. We'd have spending cuts. But we never got that. The Fed never achieved tight money. Why? Because they were afraid, because they know we have a bubble economy that depends on spending and credit. And so the Fed continued to provide it, although they provided it in a lower dose, right? But they still provided it. But at some point, right, even though money was cheap, it wasn't cheap enough, and the banks started to fail. And so the Fed stopped hiking and then started promising cuts. And that forward guidance in and of itself was an ease of financial conditions. And so the market started to price that in. That's why the long end of the bond curve came down so much. That's why mortgage rates came down, because everybody started to price in these Fed cuts. But the cuts shouldn't have happened. The promises shouldn't have been made. Rates needed to go a lot higher. Now, that's also a reason that I predicted when the Fed finally got around to doing what the markets knew it was going to do, it would be to buy the rumor, sell the fact for bonds. And that's exactly what happened, because long-term bond yields went up. In fact, the yield on the 30-year bond is now back above 4%. And in fact, I think that the low for bonds is now in. And so that's another irony, but it's going to coincide. The Fed has cut rates, and that's going to start an increase in long-term rates that includes mortgage rates. So people expect, the Fed is cutting rates, that's going to be good for homeowners. No, mortgage rates have bottomed because they already anticipated the cuts, and now they're going to rise because the cuts are inflationary, and that is going to put upward pressure on long-term interest rates. And again, credit card rates are not going to be affected at all by these rate cuts. They're going to keep on rising because of the enormous level of debt and the increase in delinquencies that is going to put more losses on this industry, which means in order to offset those losses, they have to jack up interest rates even more. Anyway, let's take a quick break. I'm going to come back and I'm going to talk more about the press conference today, what Powell said, and how the markets reacted today, and how I believe they're going to react tomorrow and next week. So stick around. We'll be right back.
As a business owner, I know the challenge of navigating unpredictable markets, interest rates, and inflation. That's why having the right tools is essential. NetSuite streamlines operations and scales with growth. Over 38,000 businesses have future-proofed their business with NetSuite by Oracle, the #1 cloud ERP, bringing accounting, financial management, inventory, HR into one fluid platform. With one unified business management suite, there's one source of truth, giving you the visibility and control needed to make quick decisions. With real-time insights and forecasting, you're peering into the future with actionable data. When you're closing the books in days, not weeks, you're spending less time looking backwards and more time on what's next. NetSuite is the platform that I would choose, and you should too. Speaking of opportunity, download the CFO's Guide to AI and Machine Learning at netsuite.com/gold. The guide is free to you at netsuite.com/gold. netsuite.com/gold.
Hey, before I return to what I was just discussing, I want to make another quick announcement regarding my wife's song, GYB. I mentioned it on the last podcast. It debuted. I gave out the link on Spotify, and a number of you have already listened. Although plenty of you haven't listened, I can see the number of people who have listened. And it really is quite a good song. So if you didn't listen, you can go ahead and still do that. But I was reading the comments, and there were people who mentioned that they didn't have a Spotify account or iTunes. And so yesterday or 2 days ago, she posted the first music video, the full length, the entire song. So you can see that it's on YouTube, so you don't need to have a Spotify account. Most of my audience obviously is on YouTube because a lot of people, are watching this podcast on YouTube. So we're going to put the link to the video on the Laughing Cats, which is the name of her duo with Tony Frattinelli. So that's their YouTube channel. So I'm going to put the link there. So when you're finished listening to my podcast, click on that link, and then you can listen to her song. And while you're there, you can make a comment if you like the song, or subscribe to her channel. That way you'll get notified in the future when she posts new content up there. I know the album that this single is from, there's 11 songs, I think. So this is just the first song. So you want to, be made aware when the next song is coming out. If you're subscribing to her channel, then you'll find out. The whole video, we shot the video at our house here in Puerto Rico. We did it a few days after our Halloween party. So we still had, some of the little props left over. And so they incorporated that into the video. Now, some people ask, why am I not in it? Why didn't I make a cameo? I'm pretty sure they shot the thing while I happened to be away. I was traveling for some reason, and then they did the video. So otherwise, maybe I would have been in it. I don't know. So we'll see. But it's still, an interesting video. It's not like a big budget, but again, it's still a hobby. But I think it came out really well, and so is the song. So everybody should check it out. Anyway, back to the topic at hand, which is the Fed's decision to cut interest rates by 50 basis points. Now, one of the things that Powell had to try to do, right, with this rate cut is he had to make sure that he wasn't spooking the markets into thinking that, oh my God, why is the Fed cutting 50 basis points? What do they know? They must realize that things are really bad. So Powell went out of his way to reassure everybody that that's got nothing to do with it. Yeah, we're cutting rates by 50 basis points, but the economy is great, right? We have a strong economy. We have a strong labor market, and we don't see any indications of recession, right? So he went out of his way. That's why some people were calling this a hawkish 50 basis point cut because of how bullish Powell was on the economy. But of course, what would you expect? Again, he thinks he's a member of the Biden-Harris administration. They're talking about how great the economy is. So he can't come out and say, yeah, the economy is weak, it's going to recession. He's towing the party line, right? This whole thing about Fed independence is a bunch of nonsense. So he wants to talk about how great the economy is, even though he acknowledged, that the jobs numbers have been revised, and so they may be revised again. He's still talking about how strong our labor market is. In fact, before the Fed decision, I'm watching on the financial news. By the way, I was on with Liz Clayman today on Fox Business. So I came on immediately after the press conference. So we're going to post that interview on my YouTube channel. So I was one of the talking heads, although I'm not really a talking head. I'm telling the truth. But in any event, I was watching some of the other guys talking about the rate cut, and they were talking about how, it's rare, it's odd that the Fed would be cutting rates with unemployment so low. In fact, it's 4.2%, right? Which historically people are commenting that was full employment, right? I mean, people didn't even know if unemployment can get that low. Well, the reason that the Fed is cutting rates with unemployment so low is because unemployment is not low. The number is a joke. And I think the Fed knows it's a joke. Remember, the U6 unemployment rate is 7.9. That's high. And before 1994, that was the only rate we had, was U6. They didn't call it U6, but that was the unemployment rate. And in fact, it counted a lot of people that are excluded from the U6. So if we still counted the unemployed the way we did in the early 90s and in the 80s and in the 70s and in the 60s and in the 50s, unemployment is historically high, right? So that's why the Fed is cutting rates, because unemployment is high, right? The numbers that we're spoon-fed by the media and the government every month are wrong. If we really had unemployment that low, the Fed wouldn't be cutting interest rates, but they are, because we have an unemployment problem that's going to get worse. But the bigger problem is the debt problem. And the debt problem is going to keep getting bigger and bigger and bigger, again, regardless of whoever wins the election, because everybody is promising tax cuts, including, Harris is backing away from a lot of her tax hikes on the rich, right? But she's still promising tax cuts for everybody else, all kinds of free money, right? Some of it isn't tax cuts, it's just government giveaway, give you money to have a kid, give you money to start a business, right? Give you money to buy a house, right? So, I mean, all this stuff is going to blow up the deficit. That's why Powell is cutting rates. It's because we can't afford the rates we've got, even though they're too low. They're still too high, considering the enormity of the debt. And so that's the reason. But he had to kind to, pretend that everything was great, even though we're cutting interest rates by 50 basis points, when the reality is it's not great. And the fact that he cut is proof of that. Now, the markets initially rallied, the stock market rallied. Gold, as soon as the announcement came out that it was 50 basis points, gold rallied and then rallied again. It didn't take out 2,600. It did make a new all-time record high. We got above 2,595. And the gold stocks had a big rally initially. So the GDX and the GDXJ both hit new 52-week highs earlier. But then when Powell started to speak, and some of the things that he was saying was interpreted as being, hawkish, like he talked about how strong the economy is. But what did they expect? He's not going to acknowledge that the economy is weak. When asked specifically about the balance of risks, if they had tilted to employment over inflation, Powell said no. He said that it's basically neutral, that the Fed is equally worried about inflation and employment. So it's not that it's more worried about unemployment, but that was a lie. Of course, it's more worried about unemployment. That's why it's cutting, because the idea that they're tight is nonsense. They're still loose. And so they're cutting because they need to be looser for a lot of reasons. One of them is employment. But I think when Powell said that, that kind of spooked the markets. Also, Powell said that, hey, don't expect, just because we cut 50 basis points this time, we may not cut 50 next time, right? And we may not cut it all next time. We're still playing it meeting by meeting. We're data dependent, going back to that. Even though all the people who fill out these dot plots, they're all projecting more cuts. Powell didn't just come out and say, yeah, we're cutting again. We're cutting next meeting. We're cutting the meeting after that. He kind of, claimed that, well, we're still data dependent. So you never know. If we get some bad inflation prints, we may not cut. Hey, we may even hike, right? So he left the door open. And so I think that, took away some of what he had given. And that's one of the reasons you saw reversals in the markets, including the fact that, it's a buy the rumor, sell the facts. So you get traders taking profits. So the market sold off and went negative. It wasn't a collapse, but they lost the gains. Gold reversed, closed negative on the day, maybe about 10, 12 bucks. I think at its highs, gold was up maybe like $25, something like that. So the gold stocks, which were up 3-4% on their highs, ended up down about 1%. So a lot of profit taking as a result of the press conference. But I think that's just a one-day event. I think what happened was extremely bullish for gold, and I think the big move is going to be higher. I think the next rally will take out 2,600. Same thing with the dollar. Dollar made a new low for the year on the yen, almost took out a 140. We did take out 84 cents on the Swiss franc. We closed back above it, but that was a new 13-year low today in the dollar against the Swiss franc. So, the dollar is slowly starting to break down. The pace of that breakdown is going to pick up now that the cat is out of the bag. We've had this 50 basis point rate cut, and we've got more rate cuts coming, right? So the dollar is going to go down, gold is going to go up, and so this was just an opportunity. This late day sell off is another opportunity. So if you didn't buy more gold before the Fed cut 50 basis points, you can still buy it tonight. You can still buy silver. Silver, is still above $30, but it's below 31. It had gotten above there. But silver is a good buy right now. Hold on. So you can call up Shift Gold, buy silver. Again, you can buy tonight. You can buy as soon as the podcast is over. Well, you can listen to my wife's song, and then you can buy yourself some gold or silver before the traders come to their senses tomorrow or the next day, because I do expect a big rally in gold on the back of this 50 basis point rate cut. And of course, I do believe that the economic data that is going to be coming out in the weeks and months ahead is going to be negative data. It's going to be negative on the economy, negative on manufacturing. They're going to have some negative jobs numbers. And the stronger inflation numbers may not show up for another few months, right? I mean, they may come out around where they are. And so as long as inflation isn't getting worse, right, the Fed can ignore the data, because the Fed is already confident, right? They're saying we know that inflation is going to go back down to 2%, although Powell was careful not to say mission accomplished, because he actually said that. There was one of the reporters that asked, would you say you've won the inflation fight? And Powell said no, which kind of contradicted what he said earlier about the confidence he had. And that's why he cut by 50 basis points, because he was so sure that inflation was going down to 2%. But then he later said, well, we're not sure, and so we're not going to say mission accomplished. Well, then if you're not sure, why'd you cut by 50, right? So nobody really asked that. But I think he was afraid to say mission accomplished because, it's probably not accomplished. So he came out with that. And so that might have also been a negative for the market. Maybe the markets were waiting for him to say, yeah, mission accomplished. Although from my perspective, he basically did that with the 50 basis point rate cut. But again, remember, when inflation was below 2% and rising, Powell never raised interest rates to get ahead of inflation. Say, look, we can see it's going up, so we're not going to wait for 2%. We're just going to start hiking now before we get there. No. Powell actually said, we're going to let it pass 2%. Right? Even though our target is 2%, we're not going to start hiking at 2%. We're going to let it get above 2% before we start hiking, because, we want to average out inflation, right? We have this inflation averaging now. So we're not going to rush, right? We're just going to, let inflation move above. Well, they have the complete opposite attitude on the way down. If the Fed was consistent, the Fed would say, we're not going to start cutting rates until inflation is below 2%. And in fact, what Powell should be saying is, we were above 2% for a long time. We were way above it. We need to average that down. We need to have inflation run below 2%. And if the economy really was as strong as Powell claims, why not? Why not let inflation be below 2%? We got this great economy. We got this super strong labor market. Why not have 1% inflation? I mean, wouldn't that be a relief? Although that's still higher prices. But no, Powell knows the economy is so weak, he can't wait for inflation to actually get down to 2% or, heaven forbid, go below 2%. He needs to start cutting now, and he's just going to roll the dice and hope that inflation keeps coming down. But why should it? He's throwing gasoline on the fire. Why should the fire go out when he's now stoking it? Now, another important point that he made, because somebody asked him at the press conference about the balance sheet. Like, hey, what are you gonna do with the balance sheet? Now you're cutting rates. What about the balance sheet? Because you're shrinking the balance sheet. You're going along with QT. Isn't that counterproductive, right? Because on the one hand, you're easing with rate cuts, but on the other hand, you're tightening by shrinking money supply or by shrinking your balance sheet. And Powell said, it's not really a contradiction, because he said, we're just trying to get to normal, right? We want to have a more normal policy. And so that means lower interest rates because they're abnormally high, which again is a lie. They're still too low. It's like we create a phony benchmark. We lower interest rates to 0, and then we claim, 5% is high. Well, relative to 0, but why is 0 your benchmark? I mean, we never had 0 until this recent time period. Historically, going back to the end of the gold standard in 1971, being on a fiat currency standard, 5% is low. Even mortgage rates where they are today, they're in the 6s? That's low. I mean, I remember mortgage rates in the teens. And even when they had come down, they were 14, 15, 16%. I remember the movie Wall Street. Remember there was Bud Fox is, right when he starts making money, he's going to go shopping, to get an apartment in Manhattan, and he's talking to this realtor, and she's like, look, I got a connection. I can get you 10% mortgage, right? That was supposed to be a deal. Wow, I can get a mortgage rate as low as 10%. So the rates we have now are low. They're just not as ridiculously low as they were when the Fed had rates at 0, but they are still low. So the Fed doesn't have to reduce rates to have normal rates. The Fed would have to raise rates to let them go back to normal. Now, I know they try to say, well, inflation is only 2.5 or 3, and the Fed funds is, 5, and that's too much. But the inflation number is a lie, right? You can't say that interest rates are not enough above inflation when your inflation number is a lie, just like the unemployment number. The inflation is actually much higher than what the government reports. So you can't determine real interest rates. You can't say, hey, we have high real interest rates because interest rates are a lot higher than the inflation rate, when the inflation rate is BS. The actual inflation rate is higher, and the bond markets would know that, right? They should. And so it's not true. But Powell claims, well, look, we're only cutting rates, not because we're panicking or because there's anything wrong. We're just trying to get to normal. And that's why we're going to keep shrinking the balance sheet, right? We're just trying to get back to normal. And so we're going to, we're going to keep shrinking the balance sheets. And so he said for some time that's going to happen. And I think that was a true statement, because I think he knows that the time is going to come to an end. My guess is that by the first quarter of 2025, the Fed is back to quantitative easing. It may even happen before the end of this year. But I think for sure, right, although nothing's for sure, but I think by Q1 of next year, the Fed is back in the QE business. Now, another question that Powell got was, do you think we're going to get interest rates all the way back down where they were, right? 0. Or they didn't say 0, but just really cheap or low. And that's what he meant, because Powell said, look, there was a time when you had all this sovereign debt issued at a negative yield, not in the US, but in Europe and Japan. And he said he didn't think we would see that again. And he didn't think we'd see interest rates as low, meaning probably 0, 25 basis points in the US, as we saw before, that he thinks the neutral rate now is higher than what they used to think it was. But he said, we have to wait and see. Greg, we don't know, right? We'll have to play it by ear. Now, the Fed is going to try. The Fed is going to want to bring interest rates down because, this is going to be a horrible recession. And what's going to be so different about this recession than the prior recessions we've had, going back to Greenspan, is that typically we go into a recession, the Fed cuts rates, and then everybody gets lower interest rates, mortgage rates come down, auto loans come down, and so people now have more money to spend because they're spending less servicing their debts. The lower interest rates also stimulates housing market, auto market, and so you get that offset, and that's how we get out of the recession, right? It's the power of the low interest rates, and the low interest rates also boost up asset prices. Well, the Fed is cutting interest rates now. Asset prices are already at record highs. I mean, they don't need to be boosted, right? We got record high asset prices, and they're probably not going to get boosted. Also, interest rates are not going to come down. In fact, they're going to go up, right? At least all the interest rates that matter to the average American. Right? Mortgage rates, I think, have bottomed and are going up. I don't care how bad the recession gets, long-term rates are going to go up because the budget deficits are exploding, and they will explode even more in a recession. So that massive supply is going to push rates up. Plus, inflation is going to heat up. And so that's also going to push up interest rates. So we're going to have a recession where interest rates are rising and not falling. And so that actually compounds the severity of the recession. And it also negates the Fed stimulus because the stimulus is actually a sedative because in order to stimulate, they have to create more inflation. But that puts more pressure upwards on long-term interest rates, mortgage rates, things like that, and on consumer prices. And the other thing that I mentioned last podcast is oil prices, how cheap they are. They're going to go way up. The main thing that's been keeping oil prices down is the strong dollar in relation to a lot of the emerging market currencies. But as the dollar starts to crack against these currencies, then oil prices go down in those countries. What happens when oil prices fall in China? Oil prices fall in India. Demand for oil in India and China goes way up. Well, that means the global price of oil in dollars goes way up. See, we've had cheap oil on a relative basis because we've had a strong dollar on a relative basis. Well, we're about to have a weak dollar on a relative basis and on an absolute basis. And so that's going to push up demand for oil internationally, and that's going to push up the price domestically. See, a lot of people don't, put two and two together. They think, well, if we have a weak economy, doesn't that mean low prices? Well, no, because we're competing with people all over the world for a lot of these commodities. So just because, Americans are broke doesn't mean the whole world is broke, especially if it's a readjustment of foreign exchange rates. Our loss is somebody else's gain. So prices go up for us, they go down for other people. And so you have more demand abroad that offsets the declining demand domestically. And the result is higher prices. And so this recession is going to be like unlike any recession that we've experienced recently. And the Fed's antidote isn't going to work. In fact, it's going to make the economy even sicker than before. And this is what people don't get, right? They think, okay, it's just going to be another cycle. And they don't know where we are. I look at it as like end game, checkmate. It's the overdose, right? The Fed has been injecting the economy with this monetary heroin for over 20 years. And every time we come down off our high, we need a bigger fix. Well, the size of the dose that would be required now to get us high again, given how much debt we now have, it's basically an overdose. We end up dying of the drug, right? The drug doesn't help us because we need such a big dose that, you can't handle it anymore. And I believe that's where we are. Now, I thought we might have been there when the Fed went back to QE before, with COVID. and QE4. But we managed to avoid that. We managed to take on all this new debt, but now it is just exploding out of control. And that's another thing that that bothers me. I was listening to the Donald Trump rally right before I did this this podcast, and how Trump is promising to make America greater than ever. It's gonna boom like never before. He promised that we're gonna be a manufacturing powerhouse like we've never been before, like bigger than the heyday of American manufacturing in the 1930s, 1940s, 1950s. I mean, we're not even close. We're a shadow. There is no way that Trump can keep this promise. But, he's basically, I kept thinking of like Herbert Hoover. He's promising, a chicken in every pot, right in front of a Great Depression. He's promising so much that he can't deliver. Now, yes, you say all these things to win votes. I get that, right? I mean, you don't win votes by telling people how bad it's going to be, So he's making all these promises. He's raising expectations so high in this campaign for how fantastic. He's like, you're going to love your life. Everything's going to be great, right? Crypto's going to be great. I mean, in fact, I listened to him, his family on X, they came out and they launched some new crypto project, which I think is unfortunate that Trump has gone down this. But, it's not Bitcoin. What he's doing is he announced a stable coin, a US dollar stable coin backed by treasuries that he wants to issue that can be used as for payments, micro payments and things like that. I mean, we already got stable coins, but that's where he wants to go. But now he's issuing like a native token, a governance token, I don't know, that his family has, and it could sell. Maybe it's some kind of a pump and dump. But I thought the interesting part, to show you how little Donald Trump actually knows about crypto or Bitcoin. I mean, maybe his kid Barron knows something about it. But the guy that was interviewing him, who's running his business, asked Donald Trump, hey, you used to be negative on Bitcoin. What turned you around? Why do you like it now? And his only answer was, well, I sold these NFTs and I thought, wow, this is cool. I got money selling NFTs. So that was it. It was the NFTs. That's what turned him around. I mean, that's all he knew was NFTs. Look, he's trying to get votes. That's what he's doing. He's trying to get votes and money from the crypto people. So yeah, I love crypto. Crypto's great. But that's what he's doing by, promising no taxes on Social Security benefits, no taxes on overtime, no taxes on tips. I mean, all this stuff, it's all great. Everybody, but he's not just promising tax cuts. It's this huge booming economy that he's going to create. He's going to fix everything right away. He's going to solve everything immediately, and it's all going to be fantastic. And, it's dangerous because it's not going to work out that way. Not that I want Kamala Harris. Some people misinterpret, if I tweet out anything, or not tweet, I'm sorry, Elon, if I post something on X, like I pointed out on X today, that Trump is advocating his own form of price controls with capping of credit card rates, right? People don't like it when I criticize Trump. I got to criticize him when he's wrong. Otherwise, I don't have any credibility. I'm not a hack. I'm not just like, oh, the guy walks on water. Everything he does is right. I've never been like that. I've always been critical of people from both parties, both Republican and Democrat. I can still support the lesser of the two evils, right? I can still say I'd rather have Trump than Harris, right? But still be critical of Trump when he's wrong. Because the people who are not critical of Trump, the people who just, just mindlessly applaud everything he does, they have no credibility. I mean, the same thing I thought was happening when I was very critical of George Bush, George W. Bush, leading up to the 2008 financial crisis. And all the other Republicans were saying how great the economy was. And I was saying it wasn't great. It wasn't because, I preferred to have, Dukakis or whoever else, in office. I'm just telling the truth. And yeah, I prefer to have Trump as president than Harris. But I'm going to tell you the truth, right? That what he is promising is not going to deliver the prosperity that he claims. In fact, we never had the great economy that he pretends we had. And we don't have a great economy now, and that's what Harris is pretending. They're all pretending that they accomplished stuff that they did not. But does that mean that Trump is as bad as Harris? No, Harris is worse, right? But those are our choices. Now, there are some things about Trump that are actually good. I'm not saying that everything he says is bad, right? There are some good things that he says and that he might do. But the overriding problem is we are on the verge of this massive economic implosion. I mean, this is much bigger than the 2008 financial crisis. It's not even close what we're on the cusp of. And again, if you remember what it was like in 2006 and 2007 at the Fed, in the Bush administration, everything was great. In fact, even the election, the 2008 election, right? It wasn't even about, the financial crisis and the primaries. I remember on the Republican side, Ron Paul, right? Because I was an economic advisor to the Ron Paul campaign. He was the only guy in the 2008 Republican primaries that was talking about any of these issues. Nobody else wasn't even on the radar, even though we were, on the cusp of the financial crisis. Now, the financial crisis finally hit, right? Because it started in the summer, like August, September, and then we had the elections in November, and that pretty much sealed Bush's fate. Obama, or not Bush, but Obama was able to win because McCain, had, the blood on his hands from the Bush administration. In fact, I remember McCain interrupted his campaign to go back to the Senate to vote in favor of the TARP bailouts, which, basically, that was the worst thing he could have done. I wish he would have interrupted his campaign to vote against it, right? To take some kind of principled stance that he was against government bailouts. No, he had to go back and vote for the bailouts. But the minute he did that, I thought, that's it. He can't win, right? He's lost whatever credibility he might have had. And so that's what helped Obama win that election. But we are close, or as close, to something much, much worse than we were then, because we've been building up this problem now for well over a decade. And all the same people at the Fed, the same people in Congress don't realize, right? We're promising all this great stuff that's going to happen. Both candidates are promising great stuff, right? Harris, I'm going to have this opportunity economy, right? It's going to be great, right? Of course, why isn't it great now, right? She's going to do all this great stuff that she's not doing now, that Biden's not doing. But somehow, if we reelect her, she's going to deliver all this great stuff that they haven't been able to deliver, for the last 3.5 years. But she's talking about how great it's going to be if we elect her. And Trump is talking about how great it's going to be if we elect him. And they're both wrong. It's going to get worse no matter who we reelect, right? Because the chickens are coming home to roost. We're going to have the real crash that I wrote that book, The Real Crash, in 2013. That was over a decade ago, right? Go back and read that book, because the stuff that I said was going to happen in that book is what's going to happen for the exact reasons that I said it was going to happen. The only problem is it's taken a lot longer. Now, I didn't put a time, limit on it when I wrote the book, but I assumed back then that it would have happened by now, but it didn't. So that doesn't mean it's not going to happen. It just means it's going to happen much worse. And again, what's happening, just to, kind of wrap it all up in a nutshell, the Fed is cutting rates, right? It's not going to stop the recession from coming. The recession is coming just the same. It's probably already here. So the Fed is going to have to get more aggressive. Remember, when the Fed initially cut rates, was it 2019? They said it was a mid-course correction, like we're just doing one rate cut. And the next thing you knew, they're back at zero. And I said at the time that it wasn't a mid-course correction. It was a change in course, right? And that's what this is, right? This is the beginning of a string of cuts and a return to quantitative easing. The problem is inflation is going up, not down. Interest rates going up, not down. And now the stimulus becomes a sedative and everything starts to implode. And now what does the Fed do? Does the Fed react to the rise in inflation, the fall of the dollar, by raising interest rates in a recession, right? Something they haven't done, since Volcker days, raising rates into a recession. Unemployment is rising and the Fed raises rates. Is the Fed going to do that? Or is the Fed going to keep rates down or continue to cut rates, even though the dollar's falling, inflation is rising, long-term interest rates are rising? What are they going to do? Are they going to try to, cap rates by, massive QE infinity? Are they going to have price controls? I mean, again, Trump is already alluding. Let's cap interest rates, right? We're going to have these things, but all of this is going to be a disaster, right? And it's going to be a far worse crisis for average Americans than we've ever seen, because it's going to be a much more severe recession. People are going to lose their jobs, but they're not going to have the offsetting benefit of a lower mortgage or lower inflation. They're going to have the worst of all worlds, with soaring inflation, soaring interest rates, like the 70s, only much worse than the 70s, because we were in much better shape economically back in the 70s than we are now. And the mistakes that were made, the monetary and fiscal policy mistakes that we've made during the 2000s, the 2010s, and now in the 20s, they dwarf the mistakes that we made in the 1960s, which is what sowed the seeds for the 1970s. Well, we've sowed even more seeds of an even bigger crisis that we are going to experience soon. So again, all I can do is get the truth out there, make sure people understand what's going to happen, why it's going to happen. And so when it does happen, we have credibility. We can say, I told you so. And we can say, here's what we need to do. This is the only policy that's going to work, because the people who don't see the crisis coming, who don't understand the economics, they're not going to have the solutions. Their solutions don't work. Their solutions are just, cosmetic gimmicks that make the problem worse. And so we have credibility for being out in front of this and explaining not only what was going to happen, but why it was going to happen. That's what I did for all the years leading up to the 2008 financial crisis. But not only did I explain what was going to happen, I explained the mistakes that the government was going to make before the crisis even happened that they were responding to. And the government did exactly the wrong thing that I knew they were going to do. It's just that the consequences of those mistakes have taken a lot longer to manifest, and they still haven't fully manifest, but they're about to do that. But before that happens, position yourself, right? Make sure you've got a full allocation to gold and silver, physical. Make sure your portfolio is properly allocated for a dollar collapse. Make sure you're invested internationally, not domestically. Make sure you have exposure to the emerging markets. Make sure you have exposure to commodities and natural resources and precious metals. These are the strategies that I've been developing and managing for over a decade, waiting patiently for what's about to unfold, right? Collecting returns, collecting dividends on my stocks, not making quite as much money as the people who are in the NASDAQ or the S&P, but positioned to not only keep the profits I've made, but add considerable profits to that. Whereas the people who, rode the bubble up are going to ride it back down, right? And so they're going to lose the profits that they made. In fact, most of the profits that people made, they didn't get any dividends. It's just on paper. It's just appreciation. And that goes for cryptocurrencies too, like Bitcoin. All that stuff's going to come crashing down. And since people didn't get any return, all they had was the appreciation. Well, when the appreciation goes away, all the returns they thought they made, well, they go away too. But my returns are real, and they're going to get better, I think. But in the meantime, you have an opportunity to create a portfolio of international stocks, value dividend-paying stocks, precious metals mining stocks. So if you don't have one, make sure and contact my representatives at Euro Pacific Asset Management, europac.com. And if you are already a client, that's great, but maybe it's time to allocate more of your portfolio out of overpriced U.S. stocks, out of an overvalued U.S. dollar, into much better valued international equities in currencies, denominated in currencies that earn income in currencies that will likely gain considerably against the U.S. dollar. Anyway, that's it for today's podcast. Thanks, everybody, for spending some time with me. Don't forget, again, if you like the podcast, give it a thumbs up, leave me a comment, subscribe to the YouTube channel if you haven't already done that. And again, we're putting out a lot of great content now on Shift Sovereign. A lot of the newsletters, we're putting out the free one. About every other day, there's another free letter that comes in your inbox. The letters are really good quality, a lot of good information. It's all totally free. So make sure you go to shiftsovereign.com and give us your information so you can receive those emails. Bye for now.